joined from our Melbourne studio by Dale Gillham. He's the Chief Analyst at Wealth Within. Please welcome finance expert Dale Gillham to Studio 10. Nice to see you, Dave. Finance expert Dale Gillham from Wealth Within. It's nice to see you.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to Wealth Within Live, the stock market show where we take your questions and give you answers about all things trading and investing. Now, taking you through what we've been talking about in tonight's shows, Chief Analyst and Trader Dale Gillham and I'm Janine Cox, Senior Analyst here at Wealth Within. We're Australia's most trusted stock market educators.
hi everyone, it's good to be back again. I know Janine and I are really excited about tonight, even though our start's been a little bit delayed. We had a couple of little technical issues, but as always, we have some fantastic information to share with you tonight. But first up, we'll give you our thoughts on the market, and then we're going to go and uncover the risks with exchange-traded funds, or ETFs as they're known. And as always, we always like to ask you which stocks you'd like to hear about or our views on tonight, so we can have a good analysis on it. And our goal is to share with you our years of experience and answer as many questions as we can for you. Now, to get the most out of tonight's show, it's important and really important that you are not a bystander. So don't just sit there with your beer or your cup of coffee in your hand. Get involved and get active. And this means you need to ask questions that matter to you the most.
Tonight, as always, our goal is to share with you how you can become more profitable in today's market. So it really is important that you tell us what you want.
That is totally correct. Now, I just wanted to say thank you to the many of you that have sent us emails over the past few weeks. And you're saying to us that their awareness about the market and what they need to do, I can't say that. They need to do to become successful at growing, or their portfolio. It grows each and every show that they watch.
Now, we need to remind you that there is a chat box off to your right of the screen, so here you can ask all of your most burning questions. For now, whilst they send in their questions, Dale, why don't you take it from here? So let's bring up the charts, shall we?
Yeah, let's bring up what we do best, and let's look at the charts from that point of view. So on your screen, here's the mouse. I've got the mouse. So on the screen at the moment, you've got the All Ordinaries Index. Now, that is a weekly chart on the All Ordinaries Index. Now, I want to share with you how I think the market's going to unfold over the next sort of 6 or 7 months on the Australian market, because what I find a lot of people do is they just say, hey Dale, what's overvalued and undervalued now, but they never look at the future, or they don't understand how the market's going to unfold. Now, for those of you who are students of ours, or you've read my book, you'll know that I talk about the market unfolds in price, pattern and time. And it's not just good enough, as Warren Buffett said, just to look at price alone. You need to look at pattern and you need to look at time. Now, for those of you who watched my weekly market report yesterday on YouTube, which went out about 6 o'clock last night, it generally goes up 5 to 6 o'clock every Monday. You would have known that I was talking about all these opens and closes here being right around that little same area. And if I use my crosshair tool sort of here, you can see here how the close on this bar, which is the start of March, look at all the opens and closes around that horizontal line. They sort of range from there through to there. And I said for our market to be bullish, it needs to start closing above those sorts of levels. So it is interesting, or will be interesting to see. Now, this bar here covers yesterday and today. That's it. So there's only 2 days of this week in that bar. Now, what we need to see, obviously, is this to continue moving up and break through that high of 6372. If it can do that, then the market will go bullish. But if we see by the end of the week, like it happened last week, see this week it open low, push right up to here, and then come back. So if I go to a daily chart, you'll see what I mean. You can see it moved right up and then it came right back there Friday, Thursday. So it came right back again. So if that doesn't happen, what we need to see is this move up and hopefully close above that. If it does do that, the market will continue to rise. If the close comes back down again, we're going to see a fall away. Now, what I want to share with you here, and I'm just going to get one of my tools in here. Where is it here? It's called, there we go, trend arrow tool. So what I'm thinking is one strategy is it's going to go up somewhere up to here over the next few weeks and then come down somewhere into this sort of area here. That's one strategy. The other one, if I use the same little tool again, will be that it does what it's done there. It's going to come down a little bit earlier. Into that low there. So I was hoping it would come down a little bit lower into this sort of area over those few weeks. And you remember, if you've been watching my reports for a while, you would have known that I was hoping that it was come down, or I was suggesting it should come down into this area, which means it's much more sustainable. Obviously, whichever way this is going to go, now this is sort of 2 for 1, half dozen for the other. People say, well, Dale, you say it's going to go up, but if it doesn't go up, it's going to go down. Of course, you're going to get it right. But it's about having a plan for both, not no matter which one I get right. I don't mind which one I get right. Is what's my plan and how am I managing the stocks. Now, if it does this first, then the next move out's going to be quite bullish, and it'll go right through that high. Now, what we need to do is to add another little trend arrow. For example, it will go up, and then it'll come down into this sort of area here. Now, what we're looking at here is this area here. If you can see my little thing here, this area here comes between basically early May and June, roughly in that area. So if it keeps going up, then it'll probably be more sort of that side of it, the right-hand side of that midline. If it starts going down now, it'll be more on the left side of that midline. Now, the next low that we'd be looking for is later in the year, that third quarter into that fourth quarter, sometime around late September into that sort of November-ish, mid-November-ish would be the next one. Our market makes 2 major lows a year or 2 pullbacks every year, and as long as you understand where they are, means you can actually plan out what you're doing and how you're doing it, what stocks you're buying and when you're buying it. Now, a couple of other things that I wanted to share with you at this point in time is just have a little bit of a look at the sectors. So these are the sectors in the Australian share market at this point in time. And if you look up there on the right-hand side, it says it's a 1 month. So this is what's going on this month. And you can see materials has risen 3.27%, information technology 2.7%, energy 2.14%, healthcare 2.14%, and consumer discretionary 2%. Looking here, you can see utilities is down 1.96%. And financials and communications down a little bit. Now I want to go to here. Now this is an interesting one I wanted to share with you. It's called a relative comparison in terms of this is what we do. We call these spaghetti charts to our students because we really sort of like to just make really simple terminologies. Did you want to talk about relative? You haven't spoken yet.
We like our spaghetti charts, don't we?
I just like spaghetti.
Yeah, fantastic. Look, I'm more of a chicken person myself.
You're a chicken person.
Okay, so looking at the spaghetti chart there, it's actually showing you what is moving faster than other sectors. And so particularly looking towards the right-hand side, closer to where the codes are for the sectors, you can see all the sectors on the right-hand side there. You're looking for sectors that are actually pointing up, ones that have got more momentum and are moving in the right direction, with the theory being that if something's moving up, then it's more likely to continue moving up, and the ones that look like they might be turning then may continue to fall down or continue sideways. So looking at that now, Dale, do you want to explain what you were going to talk about in relation to which ones?
Yeah, I was just going to show where my pointer is now at the XAO. It says a brown one, which is that line right there. So the XAO is it's in the middle of it. So we've seen the XAO here. So the All Ordinaries Index, which is 500 stocks, has risen 4% over the last year. So if you see up there, it says the last year. So it's measuring 12 months. So the All Ords is up 4% in the last year. But if you'd had more material stocks, you'd be up obviously higher than that at 14.2. Now, if I click on that, it just puts them all in order now. So we've got information technology at 25.52. That's pretty
that's
impressive.
A nice move.
That's a beautiful move. Materials at 14, healthcare at 10, industrials at 7, and obviously the All Ords at 4.2. And right down the bottom, financials. So if you've got banks and other financial companies in your portfolio in the last 12 months, you know why your portfolio's been dragged back a little bit. Obviously, energy, consumer staples, communication services, all sort of just in the positive there. But what we're looking at here is what Janine's saying. These are the stocks, these areas are where the stocks are rising right now. These bottom ones are where they're stagnant or they're falling. So these are going to be the opportunities coming up down the track, where these is where the opportunities are right now. Now we
talked about some of the gains when we showed some of the data to demonstrate how often stocks and markets might only have a negative move for a year or two and then they turn back positive the following year. That's what you're meaning, isn't it?
Yeah, that's what we were doing. So that's the stuff we talked about last week and the week before, I think, wasn't it?
Yep.
Last couple of weeks we've been chatting about this, because nothing rises 100% of the time and nothing falls 100% of the time. So this is really interesting, looking at sectors and what's actually moving in the marketplace at this point in time. And you can see how fast this information technology is moving against the other sectors here. So that's sort of something that you're going to be looking at in terms of, well, okay, now look at that information technology sector and see what's actually moving. It's a form of top-down analysis, if you've never studied that, or we do talk about that. That's one of the first things we talk about in our courses, actually, is top-down analysis, looking for stocks to buy, because good traders actually plan themselves out. They don't just look for a stock today. They're looking at 1, 2, 5, 10 months down the track and what they could be adding to their portfolio, because your portfolio won't stay the same. You're actually moving in and out of stocks all of the time. If you have a medium-term view, you'll be moving out of about 30 to 50% of your stocks at any one year. So you always got to have that pre-prepared, what could be coming into your portfolio. So, and that's really what we're looking at. So that's really my take on the market at this point in time. Now, I know we're going to do some other stuff in a minute.
Yep. Oh, look, that's great. Thanks, Dale, for that. And now, last week, you remember that we shared how the market and the sectors performed for the month. You also shared our search into the top 20, and we did a lot of research on BHP and shared with you our thoughts on that and what you've got to look out for. So hope you enjoyed the discussion on BHP, and Dale talked a little bit more about the sectors this week, obviously, because it's something that's going to keep coming up week after week. It is important to keep an eye on the big picture and what's going on the market. Now, look, we showed you things to watch out for and avoid, some of the biggest pitfalls on the market, which was when the company releases a glowing profit result and then looking at the price chart to see what was actually more likely to occur.
All-time record profits, the stock falls out of bed.
Yeah,
that happens
and
all
look,
the time.
when people start working with us, they really start seeing what's actually going on out there, which is quite contrary to what you often read in the media or in publications that are put out by brokers. So looking at the price chart can indicate that there's a higher risk time to buy rather than a good time when some of these news reports come out. Now, our goal was to raise your awareness of what those in the know see and as opposed to what the uneducated do, which, that's what happens. Unfortunately, there's a path that we all take to getting knowledge. I've explained some weeks ago that I went down a similar path, reading newspapers and magazines to start out with. And I think a lot of people start in the same place. So you might be looking around on the internet, reading material as you're getting your toes in the water. But then I got to a point where I just decided, right, I need to jump into this. It's something I really want to do, and I'm not going to do it by half measures. So that's why I made the commitment to do study. So
it's like that, isn't it? It's most people get led by the media about what to do, and that's really what it's about. They look at the media and they look at a whole lot of other stuff, and they let other people lead them around about what they should be doing with their investments rather than know themselves.
Well, you've got to actually get to a point where you can trust yourself and what you do, and that's really the challenge for a lot of people along the way. And even people, when you're going through the course and you're learning how to trade, there'll be points at which you'll be asking yourself, am I getting this right? Am I doing the right thing? And that's what we're here to support you through all the way.
And the questions that people bring up regularly, like, is this overvalued or is this undervalued? One question, or two questions actually. Another one is this a buy or is this a sell? Another one is, how far do you think this will go? or do you think it's going to get to this sort of level? They're all indications that you don't know enough. It really is. That's all they are, is an indication that your education is not a level that we needed. And we find a lot of, you don't know what you don't know. And
So true.
sitting here, I don't even know what I don't know about trading the stock market. I know a lot, but I probably don't know everything, and I don't know what that is at this point in time until somebody alerts me to it. All we're asking you to do is take some of what we're talking about and test it to see if it works for you. And if it works for you, keep using it, because you'll make money out of it. If it doesn't work, don't use it. Simple as that. But thanks, Janine. What I'd like to do now is take you through some more research that we've done. And this time it's about exchange-traded funds, because Ian last week asked us about an ETF called HACK. And yes, I said HACK, H-A-C-K. So I did a little bit of research. So yes, Ian, I did some research. If you're on, I don't know. Janine's got my iPad, so I don't know if you're on, but I'm assuming you are. So I did a little bit of research on ETFs. I did a recording yesterday.
Ian S. you're talking about, isn't it?
Ian
Yes,
S.
he's there.
He is on. Well done, mate. Keep going.
He said he loves these live sessions. Also a new student to the diploma since last week. Congratulations,
And
Ian.
he's loving it, and Dale's the best looking dude on TV he's ever seen, right?
He didn't say that.
He didn't say that. But basically, it's, as I said, you made me do a little bit of research. I did my recording yesterday on ETFs and the risks involved in ETFs. So we'll talk a little bit about that tonight, but I suggest you go and have a look at that. But it really is about what you need to be aware of.
Now, we often talk to traders and investors about investing in the biggest companies on our market. Might be in the top 20 or the top 50 stocks. We're increasingly being seeing investors who are deciding, rather than invest directly in these stocks, to just buy an ETF. Now, let me ask you a question. Do you believe, right, that ETFs...
You're asking me the question? Or?
Well, look, I could ask this to people out there as well. Do you believe that ETFs have made it simpler for investors, or are they just doing the same thing in a different way?
Are they making it complex or making it easier? Because I know with ETFs, people are... it's that perceived control, and that's really what it's about. And so if you read or watch my video yesterday on ETFs, you'll see here that I was talking about during the GFC, people just deserted managed funds because they all took huge hits. The managed funds just tanked. And I know I hear Janine on the phone so often when we're managing clients, funds. We have the clients ring up and they talk to Janine on a regular basis, about what's going on in the market. And Janine's saying, when all ships rise and fall on the same tide when you're in a managed fund that covers an index. It's simple as that. And so where an active portfolio absolutely kills portfolios that are sort of buy and hold to the index is when the downward moves happen. We're out of them where the index is taking the hit. And all the ETFs and all the managed funds that track the index are all falling away, where we're already out of the stocks. So you're getting the gap between our returns and an index return is going like that. Ours are staying up where the index's stuff is going down.
Yeah, the interesting thing is that all of this started to change. People didn't even know what an ETF was until after the GFC. And it was brought about by the fact that people were paying their financial advisor or were investing, and it was costing them more, and yet they didn't get the result that they wanted to. Through the GFC, they saw their portfolios deteriorate significantly. So people were looking for a cheaper option, and the industry really took that bull by the horns, came out. There was some big vested interest in there pushing ETFs into the marketplace. And now, even self-managed super funds hold a large percentage of ETFs in them.
They do.
There's about 1 million self-managed super funds now, or round about that, and there's something like 700 billion, I think, money invested in ETFs.
I've got some research that I printed up today, so I can actually give you some.
You're going to share that with us?
I haven't shared it with
Aren't
Janine, guys, so it's new for her. Basically, this came from CanStar, so I just typed in best ETFs or the ETFs. And so I got some research from CanStar, and it says the popularity of ETFs in Australia soared over the last decade, basically because people were voting, I don't want to have a managed fund, so what else can I have? And the industry was losing so much money, they had to do something to stem the flow. So basically they said ETFs is a new word. Let's put you in a managed fund, but let you have perceived control that you can buy them, sell them whenever you like on the exchange. But let's face it, people buy and hold, they don't buy and sell. So they stay with those ETFs, but you still have the same fund manager as you had before when you had a managed fund, only now that you can buy and sell it on the exchange.
I guess the one difference is that back then people were being convinced to stay in them.
They were.
So we had calls from clients who they were telling us, oh, look, my financial advisor told me to stay in this and it's down. Now, there were some good, more active financial advisors, but then the advisors at the same time didn't know what was going to happen on the market because they don't analyse the charts necessarily, although we have actually changed the thinking of quite a few financial advisors who have actually done our courses and do know that. But, you know, in looking at it now, it's all good in hindsight, isn't it? I mean, we were looking at the market falling and we took our clients to cash. And, you know, and they actually got quite, you know, excited by that when the market started rising in the middle of 2008 and we were in cash and they were wanting us to buy. And then, you know, we were vindicated, of course, when the market fell away after that.
Because there was a lot of people with margin lending on their managed funds and everything
the margin lending curve is like a big bell curve that just rose with the GFC and fell when you know, rose with the bull market into 2007 and then fell after the GFC substantially, and we're still nowhere near those sort of levels with margin lending at the moment.
So guess how much is in ETFs in 2018?
Well, look, if there's 700 billion in self-managed super funds alone, I'd have to say that it would be at least triple that, wouldn't it?
No, 40 billion in funds under management in 2018.
Oh, okay.
Representing an increase of more than 10 million since July 2017. Vanguard's quarterly ETF report to December 2018 also found that 6.4 billion was poured into annual cash flow number.
So maybe it's 700 million. I might have got my figure wrong then, because you would think that the managed funds would hold much still, and super funds would still be holding much more in that area. But for an individual, it's really different because you're sitting there thinking, oh, I'm holding an ETF and I'm diversified. Well, there's another story around.
Isn't that the biggest lie they've ever been told?
Yeah, because when we look at markets and what happens around the world, a lot of things fall around the same time anyway, as we showed you. We demonstrated that recently. Okay, well, some investments may have different exposure to different classes, like fixed interest. Some ETFs have different, you know, products within them or exposure to different things within them, and that may settle it out and balance it out. But over the long term, it's how do I get the best return on my money out of the market and take the lowest possible risk in doing so. And to just sit there and buy and hold an ETF that's tracking a benchmark, just look at the benchmark and what the benchmark's done in history, and that'll tell you what the ETF is likely to do.
And it will. It absolutely will. If you're buying an index ETF that's going to match like the All Ords or the XJO or something, you really are wasting your time and money doing that. You're really better off just buying the top 10 stocks on the Australian market. And I prove that in my book. So if you don't believe me, go and buy my book. The research is in it for $30. It'll help you out a hell of a lot. You'll make far more money and you'll have a lot less stress in your life. And you'll still have total control over what's going on. And people are getting sold this thing with ETFs on index investing. Now, where they're exciting are things like Hack, like what Ian was talking about. Hack is basically tracking it's an index in the US on the NASDAQ, and it's cybersecurity stocks and technology type stocks. So it's tracking those. So that's an area that I don't understand. I don't ever want to understand cybersecurity. It's just a whole minefield of stuff. So looking at stocks in that area, I can look at them on a chart and know exactly technically what they're doing. But fundamentally, I'm going to be confused with those, even with my level of knowledge, because they're just a foreign industry. So whereas I can understand a bank, or I can understand.
Whereas some of the commodities, you can actually get good exposure to ETFs without taking all the leverage of other vehicles that might have exposure to those particular commodities. So that can be quite good.
Yeah, they are. So to me, they do have a place in your portfolio if you're a more passive investor. But look for some of those sorts of areas where you might gain some exposure and you don't put a lot into them. But if you have a portfolio that's just ETFs, then you really are not doing the right thing by your portfolio. But let's go and have a look at some charts, because I want to take a look at some charts of the biggest ETFs on the marketplace and compare that to the underlying index like the XJO. And let's see how the S&P ASX 20 actually performed relative to those stocks. So on your screen right now, we've actually got a chart that I did up a little bit earlier today, and I've got on here the beta shares Australian 200 ETF, the Vanguard Diversified Conservative Index ETF.
So that's the spaghetti chart again.
That's the spaghetti chart again, and the State Street 200 ETF. So these are very large ETFs from 3 different providers, and I've colour-coded them so you can pick up the line. So this purple line is the Vanguard one. This brown line somewhere through here, that is State Street. And the black one, which is this one through here, that is beta shares. So all tracking that same index, basically.
But what's interesting is that the beta shares and the Vanguard Diversified have already turned down.
They're already turned down.
And yet the top 20, the XJO and the XAO are still pointing up. So, that's showing you that the top 20 is actually doing better than those particular ETFs at the moment.
Yeah, so this is just the top 20 shares on the Australian market for that period of time. Now you can see here how the Vanguard was outperforming here, but over here it was way underperforming, and they've all had their sort of time in the sun. So here's the ASX 20 above here.
Well, it's the angle that you really got to look for, because if the angle of the rise for all of these is often quite similar, and that's what's more interesting here, I think. If you're looking at what happens, and it's more about when they turn, like which one turns first, and is one turning down or is one starting to turn up, and just getting that indication of what's going on and whether there's a change. That's really what it's important to show you here.
Yeah, well, obviously this is just 20 stocks, where this one is 200 stocks.
Yeah.
That's really what it is. So in that 200 stocks, you're going to have some going down, some going up, some going sideways, and you're getting that average return. And I was saying to a lady in the US that I'm working with and mentoring, and I was saying, because she has a few ETFs in her portfolio with an advisor, and I said, all they're doing is squashing your volatility. They take out your upside, they take out your downside, and they let you have an average return in the middle. And funds aren't there to try and beat the index by too much, because if they beat it by too much, then you're going to ask for that every year.
Although it might be a good way for some people to start, like, with an ETF, because it's just one thing that they've got to trade initially if there's enough data. But I find that with a lot of the ETFs that there's not a really good history on some of them, and some of them are even not highly liquid. We showed you, was it last week or the week before, how to look for liquidity by looking at the bar charts, and in looking at that you can tell just by looking at a chart of an ETF.
You've got counterparty risk, you've got tracking risk, you've got fees and charges. There's a lot of fees and charges in these things that people don't understand.
Yeah, I think the biggest thing too is that we haven't gone through a period on the market where so much money has been invested in ETFs, and we don't know when the next major correction comes, we don't know what that means for the ETFs.
Well, I know what it probably will mean. People will go out and get a lot of margin lending and start leveraging more and more into ETFs, and then when the market does melt down, they're going to get caught.
Yeah, because they still haven't, learnt really from the lessons of the past, which is what the market is about, and it's why things repeat on the market all
now,
the
look
time.
at the interesting thing on this chart is that my text in black. An ETF on the top 200 shares is, in theory, has all of those shares in the ETF, all 200 shares, collecting the dividends from that. And yet the returns you're seeing there, the top 20, doesn't include the top 20, the XJO and the XAO figures. None of those include dividends. That's just the index itself.
Yeah, but it'd be important to look at the actual percentage returns, and perhaps we can look at that at some stage down the track and discuss that as another topic.
Yeah. So we need to move on.
Thanks, Dale. That was really good. Thanks for that, Dale, and I hope you enjoyed that. Let us know if you found this topic interesting. We have a lot more research to share with you in the coming months. Before we move on, I just wanted to talk about a couple of points that people are raising on the chat. Now, thank you all of you for actually making comments there and saying that you love the show. So we've had a question from Steve Gray, and we're going to get to that in a minute. He's brought up GMG. Yep, Todd said that he's brought out the bear in himself this week, so good on you, Todd. You're switching camps from the bull to the bear. And Ian, he's loving the sessions. David Murray said he loves the show. Kang wants to look at QBE OR, which is Aura Cobra. David Murray's up to Module 5, and he said he wants to look at Bellamy's, and he's taken an entry in the stock, and it's now down around 8%, and he's looking at his stop loss and wanting our thoughts. Emily J said she's interested in MND and wants her thoughts on that. So I thought perhaps we could move back to Optima for a moment and just have a quick look at what a couple of these stocks are doing. Now, if we don't cover them all tonight, then I'm going to apologise for that. However, we'll do our best to get through them. So how about we bring up a few stocks, Dale, and
Okay,
get
do you want
that
me to
going?
type them in? How
Yep,
about
that'd
I'll
be
type 'em
great.
in? You tell me, you speed them out and we'll talk about
Okay,
them.
let's look at GMG, and I'll just mention a couple of more things on the chat forum tonight. Michael said, "Keep up the good work, guys." Gregory Asmanis said, "Good evening." Annie said, "Hello, thank you, Annie." Sam Draper, "Good evening. Just enrolled in your diploma course. Loving the comprehensive knowledge provided. Really feeling the value of the education. Thanks very much for that, Sam, and we hope you really get the most out of it. We'll do everything we can to help you maximise your learning along the journey." Then I've got another here, Natalie Sainsbury, "Evening, Janine and Dale, partway through third module and loves what we do. Thank you very much." Jeppert, I hope I've pronounced that correctly. Please let me know if I haven't. Said the show's nice. Use ETFs to go into national markets without international trading fees. Okay, that's a good perspective to have. Thank you for that comment. Gregory's looking for our opinion on Grange Resources as well, so I'm going to add that one to the list.
Didn't we look at that last week?
Grange, I can't remember looking at.
No, we didn't.
We'll give that one
that's okay.
a go as well. And
All right.
Natalie, Shane and Natalie are having a good chat there on the forum as well. And Jeppert, I hold Robo, Hack, IHVV. These are all ETFs, I'm assuming. NDQ for international exposure. Okay, thank
So
you for
let's
that.
look at the chart you've got on the screen. It's actually Goodman, so we're looking at that for. Didn't quite read some of your
Well, I've got writing of a doctor's. Is that what you're saying?
I didn't say that. I just said I was having a little trouble because I've got to have glasses on to read fine print.
Okay, he's being polite now, I think.
But look at this stock, isn't it a magic stock? It's just moving up very, very, very nicely. And it's all about momentum, and you can see here how the momentum's really taken off on this stock. So if I'm not my trend arrow, I want a trend line. Look at the angle of this now as compared to here. So it did that for a little bit, did it for a little bit there. It's steeper now than what it was there, and it's steeper now than it was there. So it's gathering momentum as it's going up. Now, eventually it'll go up more vertical, and you look at that angle on that one now. If I draw my line through here, now the angle on that's a lot steeper. If you compare those two, the angle's steeper, and it hasn't done that really for any length of time through here. So what we're looking at here is this thing will start to exhaust itself fairly soon in terms of that, because how long can it keep going up within a major pullback? Because if we look at the whole history of this stock, its all-time high was right back there, back in February 2007. So it's been rising beautifully right through since March 2009, and it's eventually going to run out of steam. And so at this point in time, I think it's going to start to slow down a little bit in terms of that, and then maybe come back down a little bit. But if you're in this stock, stay with it. It's looking magic. And this is where I find some people.
Well, it depends if you're in it medium to long term, or if you're trading more shorter term and going in and out, really, doesn't it?
Yeah, and that's all context. And to me, that's really what we talk about. Is some people say to us, "Oh, is this a buy now or a sell now?" And that's what Janine and I were talking about last week. Is it could be a sell now for somebody, or it could be a buy now for somebody, but for other people it may not be, depending on your rules. And looking at this point in time, you'd stay with that if you owned it. You wouldn't be getting out of it. You'd definitely be staying with it. Would you be taking a new position on it? You might, depending on the outlook you actually do have on the stock. But this is where a lot of people say to me, is this overvalued now? And really, those fundamental terms, is it over or undervalued, really those types of terms are almost irrelevant to us as traders and as technical analysts. We don't look at it as in terms of overvalued or undervalued. We look at it, is it going up or is it going down? And if it's going up and it looks like it will continue to go up, then stay with it regardless of the price and whether the market deems that's overvalued or not. And we'll continue to do that. Let's quickly look at QBE now, and look at this. This is one of those stocks you love to hate, don't you? It should have the potential, but look, it was a magic stock all the way through here. Then we had September 11th, big pullback there. It took off like a rocket to make a beautiful all-time high in September 2007. And then here we are 12 years later, and
Still
seriously,
struggling.
it's
just
still
been a dog, hasn't
struggling.
it?
So until it got sort of through this level, I don't think I'd get excited about it. It doesn't want to fall lower, but it doesn't really want to look at all that support across that sort of level, that 960 level, and a lot of resistance around that $14 level. Until it broke sort of through there, I'd be staying out of this at this point in time. And insurance or finance companies aren't being as bullish as what they were once. But right now, I don't think, if I owned QBE at this point in time, I'd make sure I had an exit strategy on it. If I didn't own it, I wouldn't be looking at getting into it at this point in time. I'd want it to see it, make sure it's starting a new uptrend, because when it does trend, it does beautiful.
All right, but you can
that's
see
not-
another reason why buy and holds, wouldn't work with this stock either, because it's just not the right strategy. It might run up for, you might be. It's all about timing, and that's what we talk about. You might have been lucky to get into it in early 2003 if you just sort of. Had a blindfold on and sort of went eeny, meeny, miny, moe, have some QBE, and it ran for 3 or 4 or 5 years up, and then the rest of the time it's spent in decline or just going sideways doing nothing.
Yeah. What was that other? Was that ORE?
ORE,
It was.
yeah.
I picked the right one. I think I put.
Orokabur, is that how you pronounce
I
it?
can't even. Orokabur.
Oh, I dare you to.
So, a little bit more volatile, isn't it? Right now, you can just say it looks like it's going down, but it does look like it's finding some support, doesn't it? Right across here. Got some nice, strong support around that $3 level. Now, obviously, we don't know whether Keung is a nice guy, whether he owns it or he doesn't own it, but it's not really relative in terms of how we assess the stock. But right now, this thing has had its most recent high in January last year. It's been falling away since. It's below a downtrend line. If I put a trend line on this, down through, and this is a monthly chart we're looking at, team, if I put it on there, you can see there it's below a trend line, and if it's below a trend line, or especially a monthly trend line, then
Which
you
should
need
be
to
a
assume-
solid line.
It should be a solid line.
I'm just picking him up as we go.
Yeah, you're being my assessor, but I'm the head assessor. I'm fully trained. But yeah, when something's below a down trend line, you need to assume it's going to continue down below that trend line until it breaks through that and proves to you it's going up. It's touching its head on it at the moment, and it may break through, but we'll wait to see what happens over the rest of this month to see whether it really does break through. But if it does, then it could start to be a nice little buy signal through here.
Now, the amount of people that have read your book and said that this changed their life and whole experience in the market just by knowing how to apply trend lines to a chart, I can't keep count of how many people have said that.
Well, Ian on here was saying, he sent me an email, I think the
Is
other
that how
day.
he started with us, bought the book?
Yeah, he bought the book. I think he started watching the videos. He's bought the book, and he'd done some courses, I think he said to me, and was losing money or not doing really, really well. Bought my book, and it's turned his trading around, and for the first time he's in profit.
That's
and
wonderful.
then that's what made him decide to move into our diploma course, which I think he started last week. I think it was. He started.
was,
So
yes.
he's only started last week, and I've got to give him a call to start that mentoring process with him. So, do you want me to look at another stock, or are we doing something else?
Did you get to Bellamy's?
No, not yet.
Just one more and then we'll move
I'm
on.
asking. You're in charge today, remember? So, Bellamy's. A lot of people, Bellamy's, A2 Milk, there's a couple of others in this sector. I know we did look at some other stocks in this sector, but look at this. It is looking a little bit better, isn't it, here? It is starting
Now,
to move up.
this is Daryl Murray, I think. Is it Daryl or David?
Yeah, Daryl.
And he was talking about it, that he took an entry on a Dow theory
So
entry.
let's
and
go
it
on to
currently
the
is
weekly chart, yeah?
about 8% down. Now, I think we covered this last week, and I did say that because of that small, tiny little week down before the high,
That one.
that I suspected, and I'm used to seeing these sorts of things happen where it's down and it's only that small move, that often it's got to come down further. It really
Yeah.
hadn't finished moving down and it was set to move
Which
in
is
that
really
direction,
what I was
which
thinking
it's
about
done.
with your Lords, really, wasn't it?
It was,
In that
yeah.
same sort of thing. But it's still a nice stock. But if you're not in it right at the moment, I think I'd just sit back and wait.
But you've got a stop loss for a reason. I mean, that's what it's there for, to protect your capital and keep you on track. So, that's what we would say. If you've got a set of rules, then you follow your rules, unless you've back tested the stock and found that there's another exit strategy. We use a 15% stop loss as a general guide, but the back testing often tells you whether you can drop that.
Yeah, and this is where people really get to. We'll get off the charts now because I know we've got some questions as well. But this is where people say to us, I don't know how many times I've had somebody say to me, I don't want 15% because I don't want to lose that much. And they're really surprised when I tell them our average loss is around 9% max.
Yeah, it depends on how you position your portfolio as well, because that 15%, if you've got 10, if you've positioned yourself into the market, originally when you set it up with 10 equal positions and you're building from there, then your risk is about 1.5% for the whole portfolio, which is small.
And you're not actually losing, just because you set your stop loss at 15% doesn't mean all your stocks you're going to get out at 15% loss. That's the point.
Yep.
Because some stocks it might give you a technical trigger of 5% or 3% or 7%. Other stocks will trigger out at 15%.
And some stocks you might get a dividend with it as well, so that reduces the risk as well. So look, shall we move on now? I had a few calls after last month's show about our direct equity managed account service, where we do it all for you. So it doesn't matter. The reason we set up direct equity many years ago was because our clients actually asked us to. And what we did is we asked them what was really important to them, and so then we came up with a system that was going to provide them with all of those benefits, and it really does simplify having a portfolio for people. So look, whether you want someone to do it all for you or whether you want to learn to do it yourself, either way, that's up to you. Some people prefer to trade and invest with confidence yourself. But look, for a lot of students as they come through the courses, it can be a matter of wanting to really focus on getting it right. And so when that's happening, there could be a lost opportunity of not having that exposure in the market or not having your portfolio managed properly. So sometimes we get people saying, look, here's my portfolio, can you take it over for me and manage it while I'm going through the course? Or they want to start a portfolio and get it going that way.
Some students, they let us manage their self-managed super fund or their big portfolio. And then they play with a smaller amount while they're getting their experience. Then they sack us in the end. They take it all over.
And we say great, because that's what we help you to do with our support service. We actually help you to take your money back and put a plan together to do that along the way. And like Dale said, start small and then build it up slowly, because I can tell you that I'll hold you to account and I'll test you and to see whether your psychology really can handle trading certain position sizes, because, if you can't sleep at night, you're nervous about trading, you're checking things every day, then it means that the position sizes that you're trading are often too large, or you don't trust your rules and you're not at that level you need to be yet. And we can help you with all of that. All right, so shall we move on to a comment that we've received from someone? A very interesting
from Jean.
comment.
Yeah, okay, cool.
So we've got that up there. So Jean Carlo... thank you for saying that.
I said that for you. Jean said, I'd like to know where I can learn to understand charts. I just don't understand what I'm looking, I'd say in the screen, but it's probably on the screen. I believe he's talking about watching our videos, whether it's the live stream here or one of our other videos. Pretty much that's exactly what we do. Looking at the charts and working those charts is exactly what we teach people, whether it's in my book or whether it's in our courses, that sort of stuff. But it's only one part of the process with looking at it in terms of what are you actually doing. Is the charts are something that just bringing up charts doesn't make you a trader. It just means that you can see some bars, but it's how to read that price pattern time on the charts before you're actually able to make some sense out of that and actually have a strategy and a process. All too often people say to me, hey, I can get some of this stuff on the web and I can learn about candles and I can learn about reversals, blah, 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 blah. But that doesn't make you a trader. Actually understanding what you're doing in price pattern and time actually makes you a trader. And that's really what it's about in terms of becoming a good trader. It's process and putting that pattern in place. So let's go back and have a look at, we've got another stock, Monadelphous, to look at. So we'll go and have a look at that and then we'll go to some more questions.
So we'll bring up Optima again if we can. Look, Monadelphous is a really interesting stock, and I'll just get that chart there for you so you can see what's going on. Really looking bullish, and we've had this really strong rise. Now, as you know, stick with protocol, and we're looking at the bull run that happened all the way from this low in 2015 up to this high in November 2017. Now you can see there that it's still nowhere near the peak that it reached in 2013. So just so you can appreciate the whole history of the stock, it hasn't always been rising strongly like that. In fact, this is what I look for, Dale. When I'm talking to students about back testing, I like to see periods where the stock's been rising and where it's been falling, because then it gives you a really good idea of what the stock how it performs in a falling market, how it performs in a rising market. And so now what we're seeing is this great performance out of MND, looking bullish, looking strong. Now, Emily just wanted our thoughts on the stock, and at the moment, if you're in it, then you would stay in it. Now, there's a nice little trough under here in March 2019. I'd say if it pulled strongly but below that, then it could come down a bit further, but you'd have to say medium to long term at the moment. It's up.
Good.
The move is up.
Do you reckon it'll fill that gap that it's had this week?
Look, gaps, you know how I feel about gaps.
I know. You like gaps in traffic, not
gaps.
necessarily in charts,
Yeah,
right?
that's right. And so looking at that, look, I would say that there's nearly 100% probability that it's going to come back and fill that little gap in there. It may not. I've moved to the daily chart, which we don't often look at, but for these more volatile type stocks, we actually do refer to that temporarily. But sticking back to the weekly chart again, we may see it just soften off a little bit first. So that's MND we've got there.
Right.
And
do you want